Hi folks, today I'm going to talk about how an extended bull run, such as the one which we are seeing in the Indian stock market, can influence our risk appetite. Now, bull runs can be both good and bad. A bull run rewards an investor for his or her patience for sitting through volatile times, investing when the markets were low. This shows that equity funds can deliver higher returns and give substantial profits. But it can also lead to overconfidence and aggressiveness. An investor who is largely investing in hybrid funds or large cap oriented funds, for example, can now look at mid cap funds or small cap funds or even sectors or themes just because a friend said that I'm investing in that sector or a relative said that I'm investing in this theme and I've been rewarded handsomely. So this can be a dangerous trade. And why this happens is because of recency bias. It reduces our perception of risk. We feel that the upswing in the market may continue for a long time and this will reward us well. Therefore, we start investing and we see a quick return from those investments, which causes us to add even more to this. So, we have to be careful and understand what is volatility. Let me give you an example. There's an investor who's holding 10 lakh rupees. They know that they need 2.4 lakhs for the next 2 years and they plan to withdraw this every month 10,000 rupees. So now they have two choices. The first choice is that take 2.4 lakhs, put it in a fixed deposit or a debt mutual fund and withdraw it systematically every month, the 10,000 rupees which they are targeting. But in this kind of scenario, an investor is likely to take both the 2.4 lakhs and the remaining 7.6 lakhs and put it into equity mutual funds, saying that I'm only getting around 7% from my FD. I'm confident that in the next 2 years, mutual funds will do well and they will give me 15% or more on an annualized basis. If markets start correcting, then you may end up withdrawing more than what you expected to withdraw in the first place, which is 2.4 lakhs. So understanding volatility, understanding our time horizon is very important. The typical signs of overconfidence and changing risk appetite is ignoring fundamentals, ignoring that inner voice that tells us that this product may be too risky for us and may not suit our risk appetite, and also following the herd. Instead, there are a few steps which an investor can take during such a time to ensure that their investment journey still continues well. One is taking a measured call. So, for example, you had invested in a large cap fund and a flexi cap fund, and maybe a little into a mid cap fund. Now, you've seen that mid cap funds have delivered exceptional returns. Therefore, you can take a call to add more there. But we need to understand that when a category performs well, there is a chance that it will correct and there is a chance that it will have an extended period of underperformance. So you have to ask yourself, are you ready to face that period of underperformance? Is this money that you're investing put with a horizon of crossing long periods of underperformance? And by that, I mean more than 3 years or 5 years. If you're well placed to do this, then you can take a measured call and invest more in such categories. But if you're not, then it's better to stick to what suits your risk appetite and your investment goals. Continuously evaluate the risk which your asset classes are facing. Do periodic reviews. Also, continue to diversify your portfolio, not only in mutual fund categories, but also among other asset classes. Most importantly, keep emotion out of the investment process. Every story that you read, every news item that you read, which is good, may have an angle to it, which is bad, may have an angle to it. But you have to filter it through your own process, your own lens, and see how that can suit your investment. This will ensure that your investment journey is going smoothly and you have anticipated some of the risk, and therefore you may not panic in case the bull run stops and corrections happen. Deep corrections, especially, can cause panic in all of us. We need to have a strategy in place that we can fall back on and execute when markets correct downwards. So, I hope this video helps you to temper your expectations, continue your investment journey smoothly, and make sure that you're invested in the right asset classes. If you have any doubts, please do drop a line or write into us at our contact points and we'll be happy to get back to you. Thanks for watching.